Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on corporate filings and see if these companies are really cooking with gas or just burning the midnight oil. Today, we are diving into International Land Alliance Incorporated report, and let me tell you, it's got some interesting notes, especially about their finances. Before we jump in, if you love getting these kinds of decoded business insights, make sure that subscribe button is hit and join our Discord community. It is in the description below, where we break down more of these filings and chat about all things business. So what is this filing all about? Well, it looks like International Land Alliance Incorporated is reporting some new agreements, a significant financial one to be precise, and they are doing it on the 13th of March 2025. Think of this as a company announcing it just signed a major deal, and by the looks of it, this deal involves them borrowing money through some special kinds of notes. Let's get into the juicy financial details. International Land Alliance Incorporated, or the company as they call it, has issued what are called convertible promissory notes. Now, a promissory note is basically an IOU, a promise to pay back money. But these are convertible, meaning the person lending the money can choose to turn that debt into ownership or stock. In the company later on, they issued these notes on several dates: the 13th of March 2025, the 16th of July 2025, and the 18th of August 2025. The amounts are pretty significant, totaling over $436,000. Imagine getting a bunch of IOs from someone, and you have the option to become a part owner of their business instead of just getting your money back. That's what Quick Capital LLC is doing here. Now, here is where it gets interesting from a financial perspective. The company didn't actually receive the full $436,000. They only got about $347,100. Why the difference? Well, it says here there were what they call original issue discounts, meaning the lenders agreed to pay less than the face value of the note. Think of it like buying something on sale. These discounts range from 10% to a hefty 20%. Plus, there were legal fees for the lender, which took another chunk out. So, the company effectively borrowed $436,000, but only has about $347,100 extra cash in hand. This is a common tactic for companies needing immediate cash flow, but it means they are effectively paying more interest up front by giving away a discount on the principal. These debts need to be paid back fairly quickly. They mature in just 9 months, and the company is paying a guaranteed interest rate of 12%. That's a pretty standard rate, but it's not cheap. Now, pay attention to this part because it's important if the company defaults, meaning they can't make a payment. That interest rate jumps up drastically. It can go to 24% or whatever the law allows, which is much higher. This means the company is under pressure to perform and pay back these notes on time to avoid a really expensive penalty. Remember those convertible notes? Here is how that conversion works. The lenders can choose to swap their debt for company stock. They can do this after 180 days, which is about 6 months, or if the company defaults. The planned conversion price is $0.11 per S-hair. Now, that might sound like pocket change, but consider the company's stock price is trading quite low. If the stock price were to go up, say to $0.5, the lenders would be able to convert their debt into shares that are worth much more than the debt itself, essentially making a profit on the conversion. But if Teresa default, the conversion price can drop even further to 65% of the lowest trading price in the 20 days before conversion. This is a safeguard for the lenders, ensuring they can still get a decent return even if the company's stock price is volatile or falling. It essentially means the company could be giving away a lot of its stock at a very cheap price if things go south. Now, all these sales, all these notes being issued were done without registering them through big public filings. They are relying on something called Section C under the Securities Act and Rule of Regulation D. Basically, this means they sold these notes only to what they call accredited investors. These are typically wealthy individuals or institutions who are presumed to be sophisticated enough to understand the risks without all the standard protections of a public offering. So, they are raising money, but through a more private channel to a select group of investors. Finally, this report also includes an interactive data file. Think of this as a machine-readable version of the report, designed to help computers and financial analysts quickly pull out key information. This is becoming standard practice for filings, making it easier for everyone to access and analyze the data. So, what does all this mean for International Land Alliance Incorporated? They've secured some much needed funding, over $347,000. With convertible notes, this cash injection could be used for operations, expansion, or whatever their business needs. However, this comes with a tight repayment deadline of 9 months and a pretty steep interest rate if they miss payments. The convertible feature, while offering flexibility, could also lead to significant dilution of existing shareholder equity if the stock price remains low and conversion happens. The company is betting on itself bouncing back or improving its financial standing before these notes become due or default becomes an issue. The strategy here is clear: get cash now. Deal with the repayment and potential ownership dilution later. It's a classic high-risk, high-reward scenario that many companies in need of capital opt for. Looking at the entire picture, International Land Alliance Incorporated seems to be in a phase of trying to stabilize or grow its operations through debt financing that carries an equity conversion option. The key for them will be managing their cash flow effectively to meet the short repayment terms and avoid default penalties. The low conversion price also suggests a current low valuation of the company, which is something current shareholders should keep a close eye on. If the company can deliver on its promises and business plan, the lenders might convert and become partners, potentially helping the company grow. But if not, the cost of borrowing could become quite punitive, and existing shareholders might see their ownership reduced significantly. Alright, that is our breakdown of International Land Alliance Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this is a smart move or a risky gamble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate secrets. Don't forget to check out the Discord in the description for more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.